silver and gold will have another huge run post bust. So once we go through a global bust, come out the other side, maybe in 2027, later part of 2027. From there to maybe 2032 or three, gold could go to 20,000 and silver 500. Those have been as you know, those have been long-term, long-held targets for me. I've had them for probably 5 years. I'm thinking now, after seeing what we're seeing now, the odds are that those, at the time, they seemed absurd. I had a lot of people thinking that's crazy. I'm beginning to think those are way too conservative, particularly for silver.
Global commodity markets are hurtling toward a massive macro inflection point as liquidity constraints trigger an aggressive rally across tangible assets. The violent pullbacks observed across raw materials reflect routine bull market corrections rather than structural tops, setting up an explosive secondary advance. David Hunter, a veteran macroeconomic strategist and cycle analyst, underscores that traditional Wall Street price models severely underestimate the scale of this structural breakout. Over the immediate cycle, he projects physical silver surging to $180 per ounce, while gold accelerates toward $6,800 per ounce before broader economic conditions deteriorate. Looking beyond the anticipated deflationary reset, his extended post-bust forecast between 2027 and 2033 envisions gold soaring to $20,000 per ounce and silver crossing $500 per ounce as systemic currency debasement takes over. Sidelined investors expecting lower entry points risk missing out as momentum rapidly accelerates. Now, we present the clips from David Hunter's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
What was the reason for that big, 35% sell-off in silver? What triggered that? And I go, did you look at what happened before that sell-off? It was straight up and straight down, basically.
Yeah.
And I saw it coming, so I did call a 30% correction, basically, in silver. So I wasn't surprised by it, but it does when you get a 30% hit. Think about that. I mean, that oftentimes that's your full bear market, right? And in silver we did it. In silver we did it in 1 or 2 days. It's easy to say that's a parabolic blow off, and we've reversed it, and now we're going down, and that's what I think a lot of analysts out there are saying. I see it as, and I saw it before the sell-off, and I see it after the sell-off. I see it as, you had this run-up, very unusual run-up, but very fast run-up from basically $48 up to 122, but in the last month from 70 up to 122, and then you gave back almost all of the January run-up in 2 days, and so I think this. The bottom on Monday, which was down under 75, probably is the low for this sell-off and the low for the correction. Can you we got up over 90 today. Can you come back down and retest? I think you can. Some doesn't mean you'll go all the way back to 75, but you could come back and retest. Will we? I don't know. Maybe you can argue that intraday on Monday, I don't remember exactly where it went, below 75, depending on what you look at, I guess, but somewhere 73, 4, 5 in there. And then it rallied and then came back and didn't go all the way back down. You could even argue that was your retest, but I don't know. I mean, we'll have to see what the next couple of days bring. But I do think any retest is this week. I don't think it's something that's a month from now. So that means, you're down there. And frankly, so many people did not take advantage of what happened Monday and said, oh, this thing's going down. People are looking for 50, et cetera. And so I think there's a lot of people on the sidelines wishing for a pullback here, wishing for a retest or lower, that are going to be disappointed. So markets tend not to accommodate. So again, it's a little bit like the stock market. I wouldn't spend too much time worrying about whether 90 is going to turn into 80 or not, because I just raised my target. Again, I'll go back to kind of my October. I had a 75 target on silver. I raised it to I think 100, and then I raised it again. I'm losing track of my targets because I've been raising them so much, but
Yeah.
I raised it again to 125, and it got up to 122 in this most recent spike. I took a look at it this week, and I said over the weekend and this week, and I raised my target from 125 to 180. I feel pretty good about that. There are people that think I'm still too low, but there's a lot of people think I'm crazy at 182. So that at 180. So that's probably a good number. But I mean that's a huge. Think about it. Silver was $30 not that
Yeah.
long ago, and if it goes to 80, it's a six-fold run in a year's time or less. Um, so, but that's where I'm at on silver, and I think it is as you know, I'm looking for a global bust later. So all these things, stock market and the metals markets, we're talking about cycle highs. We're talking, I call them my pre-bust targets, but they're basically my cycle highs. Is it possible I will have to raise it again? It's always possible, but I think 180 is a pretty big, run from here. Gold, similar story, but not obviously as elevated. I raised my gold target from 3,400 to 4,000 sometime last year. Raised it again in January to 55. I think I had raised it to 5,000 and again to 5,500 in January. And I just raised that up to 6,800 for same time frame as silver here. So I mean, again, that's a big run for gold, which not that long ago was 3,000 or below, and now we're talking about almost 7,000. So um, I think we're in the sweet spot for these metals. As I say, it's not unlike the stock market, which I think the peaks there this cycle will stand for decades. Silver and gold will have another huge run post bust. So once we go through a global bust, come out the other side later part of 2027, from there to maybe 2032 or 3, gold could go to 20,000 and silver 500. As you know, those have been long held targets for me. I've had them for probably 5 years. I'm thinking now, after seeing what we're seeing now, the odds are that those, at the time, they seemed absurd. I had a lot of people thinking that's crazy. I'm beginning to think those are way too conservative,
Yeah.
particularly for silver. So,
Yeah.
but
Yeah.
they won't seem as absurd or as conservative if we go through the bust. Because silver, let's say I'm right about 180, or just to round it off, let's say 200. In the bust, you could get silver back to $50, because it's so cyclical. So you know, I'm not about to raise my long term targets till we get through the bust and see what we're doing. But I'm just saying, if it can get anywhere near 200 this cycle, I'm not sure 500 is anywhere near close to where it's going. If we get the kind of cycle I think will follow the bust.
When a deflationary global bust unfolds, standard portfolio diversification models completely break down across international capital markets. Broad equities face catastrophic liquidation, devastating institutional fund managers who prioritize relative benchmarks over absolute capital preservation. Traditional defensive sectors like utilities and consumer staples offer little genuine shelter, as broad-based selling overwhelms dividend stability and balance sheet fundamentals. Concurrently, corporate credit instruments, high-yield junk debt, and private lending funds face acute solvency pressures as liquidity evaporates. During such aggressive financial deleveraging, asset security narrows almost exclusively to sovereign government paper and liquid balances kept strictly under the $250,000 FDIC insurance ceiling across different banks. Navigating systemic downturns requires total portfolio clarity and unwavering defensive discipline. Now, let's get back to the interview.
If you're an institutional portfolio manager, which I was at one time, sometimes your bogey is outperforming, not absolute performance, right? So if the market goes down 70 or 80%, and your holdings go down 40%, you're looking pretty good, but you've just lost a lot of money for your clients, right? So,
Yep.
but in most investors, most people, retail, small investor, etc., and frankly, all investors, I think absolute is very important to them. And so I think there's going to be very few assets that hold their value, and in Treasury's case, maybe go up. But so gold's going to go down a lot less than the market, I think. Whether that's 30% or 35 or 40%. But if the market goes down 70 or 80, it will outperform. But that's still a big hit. Silver is more cyclical, so that can go down almost like the market, I think. Copper is another metal that's doing very well right now, but is very cyclical, and that could go down a lot. So you can find sectors in the stock market that will go down less. Certainly utilities will hold up more than other things because they have the dividend, they're interest rate sensitive, but they're also now kind of being bought on the basis of their growth, for the fact that we're building out our electric grid. So they're going to get hit, whether they get hit 30% instead of 80 or 40% instead of 80, who knows? But and staples, historically, consumer staples are defensive, so they'll go down maybe less than 80. But if the market's going down 80, it means a lot of things are going down a lot, right? So it's hard for me to look at sectors and say, yeah, you can own this for defensive reasons, because you're not going to be happy with what that defensive number is. You can certainly be in savings accounts in the bank as long as you stay within the $250,000 FDIC insurance threshold. You can spread it around to many institutions if you have that kind of money to have to protect. And I'm very confident that even in a global bust, the government would fund the FDIC to whatever level they have to, because of the printing press. The Fed will be printing money like crazy. If you've got a deflationary global bust, that means the Fed doesn't have to worry about inflation. That means their only concern when they finally figure it out will be protecting the system. It'll be a free falling financial system that they have to figure out a way to stabilize and turn back up. That will take a lot of money. That's the only thing out there that can move fast enough. Just think of the pandemic and what was going on in first quarter of or second quarter of 2020. When the bond market was falling apart. Small businesses were closing, and had nothing. We closed down the economy, and so they printed all kinds of money, came up with all kinds of programs to support the capital markets, and that's what you'll see in a bust is when things are free falling. They can get creative and figure out ways to kind of stop things, but it takes time. The free fall happens very quickly. The deliberations of what to do and figuring out what to do may seem fast in a slow time when things are just kind of steady, but in free fall, days are slow. So if your day's late, you're late. So it's cash is the one thing, or money is the one thing that can be pushed out quickly, so the Fed can do QE very fast, and that's the one thing that can be enacted quickly and to stabilize things. So you will see, as I've predicted, at least that's my prediction, is that you will see $20 trillion or something of that kind of number that will be necessary to kind of stabilize things and get things going the other way. And there's leads and lags, so they're going to overshoot. So, it doesn't mean they needed 20, but they'll be doing 20 because they won't have seen the progress yet, is my guess. And you'll see similar type numbers or similar type proportionally coming out of all central banks in the world because it's a global bust. So, but in that kind of environment, yeah, stock market or stocks don't work well below government guaranteed bonds, there's gradations of it. Junk bonds don't work well. Low investment grade bonds don't probably do so well. Maybe high investment grade, double A, triple A, hold up better, but they're still probably down 20%. Private credit is going to get hammered. You're going to have problems in pension funds. You're going to have all kinds of issues out there if this comes to pass. And so, yeah, I think it's basically bank accounts within the insured threshold, treasuries of all maturities, treasury bills will hold up, treasury bonds will actually appreciate because of the rates will be coming down, and not much else.
Halting an accelerated financial freefall requires decisive and unprecedented intervention from central banking authorities. During a systemic liquidity freeze, deliberate policy deliberations often lag behind the velocity of market collapse, forcing monetary officials into hyper-aggressive stabilization measures. The Federal Reserve and global central banks will deploy historic quantitative easing programs, injecting tens of trillions in newly created liquidity directly into the capital markets. Because transmission mechanisms operate with substantial delays, policymakers will deliberately overshoot their monetary targets to ensure solvency across critical banking and sovereign debt structures. This astronomical expansion of the global fiat money supply permanently alters the financial landscape once stability is restored, while legacy equity benchmarks may require decades to structurally recover their pre-crisis valuations. Freshly printed currency rapidly circulates into supply-constrained hard assets. Physical commodities absorb the monetary dilution, establishing a generational supercycle where tangible resources outperform financialized paper assets. Investors who recognize the mechanics of central bank intervention and position ahead of the monetary flood can successfully protect their purchasing power across changing market regimes. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.